Hey everyone, it's Imran Lakha from Options Insight, back with another macro options spotlight.
Remember, like, subscribe, comment. We want to get this all over the place.
Okay, so US markets had another strong day yesterday, led by NASDAQ again. We had Tesla earnings overnight, were taken well by the market, and we saw the stock up 11% on the day. So a bit more squeezing going on in the growth tech space. Also, macro data was better than expected, so a better GDP and durable goods in terms of headlines. There was some potential softness under the hood that people have been talking about. Some other measures that give you a real read on consumption, private consumption and things like that. But the headline number was good for whatever reason, and the market seemed to like that. So that supported soft landing hopes and drove the market higher. Outside of equities, though, we did see precious metals pull back, as we've been anticipating. We think also copper's due a pullback as well. That was actually eking out some more gains, but gold and silver, GDX, having a bit of a pullback. In terms of volatility, vols did continue lower pretty much across the board. Obviously, you can see NASDAQ held in there because it was so violently higher and it's kind of driving the rally. But outside of NASDAQ, pretty much everything down half a vol to a vol point. So some consistent volatility selling going on. And we saw VIX get back down, VIX back on 18 handle. We do think that is at risk of getting taken out at some point in Q1, which we've been talking about as a theme. And we do think a 15 to 16 level may well become the new floor in VIX once we do finally break through that kind of trap door that we anticipate happening not in the not too distant future, maybe even as soon as next Wednesday when we get past the FOMC meeting. Commodity vols broadly lower. You can see that here, except for the one standout, which was up a vol and a half, which was again natural gas. Nat gas doesn't seem to be able to find a bottom. We've got it tanking another 2%. That's down 8.5% on the week. Really struggling to find support there. We do think it looks oversold. We mentioned that in our Twitter spaces. Tactical bounce may well be coming from around the 245, 250 level. But if you get anywhere near 350 again, you want to take your money because this thing is just in such a solid downtrend that I wouldn't get too excited about it. And then in terms of carry, you can see positive carry, best positive carry coming from the likes of European indices, oil and copper. Amazing how low copper realized has got to 4. It's going to have a move at some point, but the market's not really letting vol do too much. Vol's still at 28. So the vol market's certainly pricing that copper is going to have a move. Maybe when China come back from Lunar New Year celebrations, we get some sort of knee jerk one way or another. Personally, I think it's exhausted and I think it's probably going to have a move back down, which is why I put on various hedges this week in that space. Okay, moving on. Well, moving on. The MOVE index, the VIX of interest rate markets, is breaking down. So we've been talking about this for a while. Those who are subscribers to the overlay portfolio of our weekly product will know we've had some options to try and capture some carry in TLTs to play a bit of a range bound condition. And we are starting to see that happen. We're starting to see vols come down, bouncing around in a bit of a narrower range here in TLTs. And if rates vol comes down, well, generally that's good for risk assets. That's good for cross-asset volatility coming lower, which is why we're seeing things like the tech sector breaking to the upside. You see these downtrends. This is the SOX, which is the semiconductor index. That's threatening to break higher. It's got above this downtrend resistance. And if it has a charge, this thing can really squeeze, maybe even up to horizontal resistance up here somewhere. And NASDAQ's got a similar sort of chart. You look at that kind of testing, trying to take out its downtrend. It may well want to charge in the short term. We probably do obviously need to see half decent earnings out of the likes of Apple, Amazon, etc. next week. So that could derail this rally in tech, obviously, if those numbers come out as a shocker. But we saw even when Microsoft guided poorly, the stock got bought back up on the day, right? So this dynamic of addressing shorts in tech is certainly feeling like it's got some legs still, right? That's how I see it. Okay, what else are we looking at? So we're looking at the VIX. So obviously the VIX been trading lower, as we said. VIX spot gone to an 18 handle, 1886. We've been anticipating a move down in VIX, so it's not overly surprised. We do think we might get an accelerated move down post FOMC as well next week. So some people are thinking VIX puts may look attractive. In terms of the major flows that we are seeing though in the market, you can see here if we look at open interest changes, we're seeing big clips going up in the 24 strike calls in February. right? And we've been saying this is a bit of a theme, right? As a load of December upside in VIX got taken out or rolled off basically at the end of last year, people needed to replenish some of that downside tail. Some of them were a bit more patient, letting the VIX come down to them rather than rushing out and buying loads. And then we're seeing nice big clips of calls going up as the VIX is having a pretty hefty down week and going back onto an 18 handle, right? And those futures, those front month futures in February coming down to 19.8. It may well be a bit of hedging as well, getting in front of the FOMC, thinking that that's on the 1st of February. This expiry is not till, in the VIX is not till 2 weeks lower. So if we were to get a rollover and a vol spike, you'd be able to monetize those calls and make a bit of quick cash. So that may be some opportunistic timing there around the FOMC meeting as well. Okay. That's what I'm seeing in VIX. And then last thing I want to kind of talk about is fixed strike volatility surfaces, right? This is a monitor that we have internally that we run to see if there's anything going on under the hood in the fixed strike space, which gives us a sense about dealer positioning and what the likely scenarios and outcomes might be. So it gives a slightly different picture to looking at floating strike vol, which we do in our summary table that we look at every day. So the S&P has rallied about 2% since last Friday. On that rally, what have we seen in the fixed strike surface? So we rallied to about 40.60. So this is the new at the money here. The volatility level has popped. So the February vols are up a vol point. You see this front end spiking. The middle not doing too much in March though, because people are buying those Februaries for the potential FOMC volatility. That's why that front end's catching a bid. But you can see not quite as much of a bid in the longer expiries in March and June. If we look at in terms of the skew surface, we can see quite a big divergence between upside and downside. So downside's catching a bid here, so the 3,700 and below area. The upside, the 43 and above, is getting offered. Now, that is quite different to what we've been seeing, when the market rallied on data points, on disinflationary data points. You saw a bid to upside. You saw a lot of squeeze potential in the market, and people were needing that hedge and wanting to bid that upside, and you saw skew flattening. Here we're seeing skew steepening as the market's rallying. So what's that telling us? It's telling us that people are putting money back to work. They need protection as they do that, and they're more willing to sell call options against their longs. It also tells you that there's not this massive demand for upside protection that there was back end of last year, right? So giving us a sense that maybe that squeeze risk that we're used to seeing on the S&P on major data points is at the moment not really in play. Now, the interesting thing for me today is the contrast on the NASDAQ. If you look at the NASDAQ has rallied double what S&P has done, 3.7%, so just under double. And we look at a similar picture, we've seen a 3 vol increase in that front end. We've seen decent increases in June and March expiries for the at the money. So that's this part of the curve here around 12,000. But look at the distribution, right? You've pretty much got all the way up to 12.5K, is almost up just as much in vol terms as the 11.5. So you're not seeing the same skew move. You're not seeing this kind of people willing to reject upside and not want that upside. You're seeing more of a bid for upside in NASDAQ than you are seeing in S&P. So that is indicative that dealers are more short that upside, that there's generally just more demand for that upside because the tech space is the one that people are short, right? And that's where they need upside protection against their shorts. So that is a clear message that I'm getting from the changes in the option vol surfaces this week between S&P and NASDAQ. And that plays into my idea that I've been pitching lately of being long calls in NASDAQ versus short calls in Dow Jones was a good trade because it allowed you to participate in the tech squeeze, which if we were to get a rally from these levels, that would be the thing with the most beta. And I think the options market is perfectly backing up that analysis and that scenario. All right, that's it for today. Hope you found that useful. Remember to ask any questions in the comments. Happy to answer anything that comes along, and we'll catch you all next week. Take care. Have a good weekend.